Later. Today we're going to be talking about borrower conditions. Give us just a moment here to go live on all the different platforms. We put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. I see some comments were already coming in there nice and early. Appreciate everybody tuning in nice and early. We'll get started here in just a moment. Remember that we do these trainings every Tuesday and Wednesday evening at 7 p.m. Eastern Time. And we'll get started here in just a moment. All right. It looks like we are live on all the platforms, so we can go ahead and get started. We're going to take the chat off the screen, but please keep dropping comments there as you tune in, and you can drop any questions in the chat that you have as well as we go through the presentation. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We're a correspondent lender that specializes in non-QM loans, and what we do every Tuesday and Wednesday evening is go through a loan officer training on a different topic. Tonight's topic is going to be borrower conditions. So our sales manager, Jose, with 28 years of experience as a loan officer and a realtor, is going to take us through a training here. So I'll go ahead and turn it right over to you, Jose. Let's talk about borrower conditions.
Good evening, everybody. As you've noted in our last few training sessions, we are covering different facets of a loan approval. So we previously covered property related underwriting conditions and then title investing conditions. So today we're dealing with conditions from the borrower. So let's get right into it. Okay. So, like I've done in the other two trainings, I like to begin with giving some insights on what would lead to a successful approval and loan closing. And as I mentioned in the other trainings, the underwriting begins with the pre approval, right? That's the most important part when you're reviewing all of the information, all the data. Maybe you may not have a property yet to review, but you're going looking at the borrower's income, credit, assets, and if it's a refi, you definitely have property information. So, a successfully closed loan starts with a thorough analysis of the scenario, right? Thoroughly review all provided docs and information. Now, I'll give you some pointers here that would require a little special attention to give you a little bit of, context on what we're going to get into in the next couple of slides, which is actually going over conditions and how you resolve them. So when we're looking at the scenario, definitely when you're looking at assets, right, look for large deposits, who owns the account, source of funds, and seasoning. Now, it's very important to note that there are outlets that would allow flexibility with some of these items, right? Like if you have an issue with seasoning on the funds, for example, then you would look for a loan option that didn't require any seasoning on the deposits. And we do have those depending on what loan type. I mean, that's readily available for non QM. For agency loans, now that would be a different challenge. You would have to look at the selling guide for FHA or for whichever of the agency programs that you're looking to pre-approve to see how the assets are treated. But note that it's the early upfront review that results in no headaches later. Same as with employment. Um, Typically, if employment is going to be used for the loan program, if income is going to be used, we have to verify employment unless we're doing a DSCR loan or unless we're doing an asset utilization or asset depletion loan or one of the CDFI loans that we have for primary and second homes where we do not verify any income nor employment. But if employment is a factor, then definitely look at the last 2 years, especially for self employed borrowers. Complete the income worksheet for all borrower types, again, especially self employed borrowers, which tend to be a little tougher. You definitely have to take into consideration if you do have your self employed borrower, the full term of their self employment. If they do not have 2 years in business, for example, and you're doing a bank statement loan or you're doing a 1099 loan, what were they doing previously to that? Were they in the same line of work, just doing it as an employee with a license, or were they in a totally unrelated field? These are all questions that you would have to ask the borrower as you're reviewing their information and coming up with a 2 year history. Credit is another of those very important areas, obviously. But what do you look at, right? You want to review the credit report for trade lines, the credit scores, disputed accounts, charge offs, collections, excessive inquiries, social security number mismatches, address mismatches, and credit simulation opportunities. These are all factors to take into consideration when doing the pre approval, especially paying attention to the last one, credit simulation opportunities, which is one that I do not see used enough. If you're 4 points away from the next pricing tier, it would behoove you early in the process to discuss a credit simulation because of the time that it's going to take to get it done. Even if you say the rapid rescore is 5 days, the customer still has to pay off the accounts, provide the proof of the payment, the new account balance letters. If you're doing it with documentation and not the no doc option for credit simulation, and then order the credit simulation, wait for it to be done, and then order the new credit report once you have the scores updated, the balances updated. So, again, issues with credit, like everything else, are a lot easier to resolve if they are addressed early in the process. That's going to be the big takeaway here. Address any issues early in the process. And when looking at the property, again, this might sound pretty obvious, but do yourself a favor and review the property public records. You definitely want to confirm the size of the property, the room count, what is the legal use of the property, and how long has the seller, if it's a purchase, been on title, or how long has the borrower been on title, if it is a refi, especially a cash out refi. Uh, Believe it or not, sellers seasoning on title is important for many loan types. For example, for an FHA loan, you cannot enter into a contract until the property has been owned by the current seller for at least 90 days. That means you could get into contract in an FHA loan on the 91st day that it has been owned. And then on top of that, there's going to be certain other factors to consider, like price appreciation, which is going to determine if you're going to need a second appraisal. And usually these properties are going to be a flip if they've only been owned 91 days. It's probably going to be above the threshold, which I believe is 20%. Don't quote me on that, but I believe that's what it is. And then above and beyond that, you would have to order 2 appraisals and have been on title at least 91 days to be able to get into a contract. And that's simply an FHA loan. Uh, Non QM, it's a serious situation for the seller not to, to have for the property to be a flip. Let's put it that way. So look at your guidelines and see if under what cases would they require a second appraisal, or under which case they may not even do the loan. So don't be surprised when pre-approving your borrower. Try to be proactive in all of these areas. So let's get into some actual conditions. Well, actually, let's talk about some common underwriting conditions and what they could do, and then we'll get into the conditions and how we resolve them. Now, some common underwriting conditions are going to be obviously credit, which could be caused by a low score, inadequate trade lines, disputed accounts, right? All things which are readily visible when you're looking at the information. You could have uh, income conditions due to some type of income discrepancy, which could result now in your DTI being too high. Somebody didn't do an income calculation properly. Maybe there was some documentation missing. LTV is too high for the loan program. You could have employment issues due to lack of stability when a borrower has less than 2 years employment history, especially true with self-employed borrowers, or if you have a gap, too large of a gap from one employment to another, and this borrower previously may have had additional short stint jobs where they weren't there that long and then they stopped and started another job. If you have too many of those in a 2 year period, there's going to have to be some serious explaining to do. Unusual bank account activity could be another common underwriting conditions, large deposits, source of funds. Appraisal came in too low, or non-compliant use of the property, like the borrower that tells you that the property is a 3 unit property when it's actually a single family home split up into 3 units, individually rented out, split up with no interconnecting doorways or anything like that. Definitely non-compliant use. Property condition issues, right? Property needs a roof. Either stuff that gets brought up in the property inspections, or when the appraiser goes out, they make note this manufactured home has deteriorated foundation. They recommend a structural engineer's report, or you could have the leaking roof, rotted wood, whole number of things that could be property related conditions. Missing information on the application, or missing documents like IDs and other supporting documents. So let's get into some actual detailed conditions here and how we would resolve them. So I have 2.5 pages of some of these conditions that I tried to illustrate for you here. So we have, for example, you could have this the no social security card or a social security number mismatch, right? And that one you're going to know upfront before the underwriter gives it to you is by looking at the credit report. Does it have alerts for a social security number mismatch? And obviously, if you don't have a social security number, then you know that, or social security card, excuse me, then you know you're going to have to have the borrower sign an SSA 89 form, and you can submit it through, for example, we use CIC, which is our credit agency vendor, also is the vendor that we use to process our SSA 89 forms, and is also the vendor that we use for our tax transcripts when we are requesting them through an agency. So have the borrower sign an SSA 89 form, submit it through CAC, and the verification is almost instantaneous for that number. Now, the no driver's license or expired driver's license, sometimes it takes a while to either get the appointment to renew it or to order it. online and may take 2 weeks to receive. You may not have time for that, but there is a workaround there. Just have the borrower provide an unexpired passport if they are a U.S. citizen, or any other uh, government issued photo ID, either state or U.S. government issued photo ID, as long as it's not as long as it's not expired, would satisfy the need for a picture ID. Tax transcript is another condition that you may receive. But now, for the tax transcript, the report that you obtain is really going to depend on if your loan is a full doc loan using uh, tax returns for a full doc borrower, or if it's an alt doc loan, let's say using 1099s, or maybe even using W 2s for some type of non QM program. There is a wage and 1099 transcript that you can obtain. And there's also a record of account tax transcript. The record of account is the full report, it has everything in there, including what you owe if you've already paid it on your tax liability. That's the record of account. And the wage and income transcript, both available from irs.gov. Now, you can order these through CIC with a borrower signed 4506, or the borrower can go directly to irs.gov and obtain the necessary document. You just have to make sure that the URL of the irs.gov portal appears either on the bottom or on the top of that printout. Now, that tax transcript will also show you if the borrower has any liability with the IRS for their tax payments, which is another section I'm going to cover in a second. EMD, which stands for Earnest Money Deposit, EMD verification. That's another one that we receive quite a bit. Probably one of the easiest ones to obtain. And actually, this one may even be available at loan, before you submit the loan. You just have to ask the borrower for this one, how did you make the deposit? Did you make it with a check, or did you make it with a wire? So once you determine how they made it, you ask for a copy of the deposit item, whether it be the check or the wire confirmation, and then ask them for either the transaction history of that account, or, if available, the complete bank statement, so that you can reconcile the debit to the item and thus confirm that the deposit was given. It would also be a good idea, which they may ask you as well for, to ask for a copy of the escrow letter, which you can obtain either from the title company or from the real estate office, depending on who is holding the escrow. In some cases, the title company holds it. In some cases, the real estate office is holding the escrow. So, escrow letter plus the deposited item copy plus the debit of the transaction, either on the transaction history or on the complete bank statement, to verify the earnest money deposit. Verification of closed sale proceeds. This is one that we get a lot when we have a pending sale, right? From which the borrower is going to obtain the cash to close. So, again, this one is pretty straightforward. You would need to get a copy of the closing statement once the transaction closes. If it's already closed, then please try to get it up front so you have less conditions. But normally we're doing the application, hasn't closed yet, so request a copy of the closing statement once it closes, a copy of the sales contract, and the account transaction history or the bank statement, if available, showing the credit of the funds to their account. So you do this, and you will be able to clear the condition uh, for your assets from the closed sale. Evidence of insurance, right? So this is another one where it's going to depend on if it's a purchase or if it's a refi. But in both cases, obviously, we need evidence of insurance. In a purchase, I find it easiest to have the borrower provide quotes and contact info so that I can request the evidence of insurance. Right. In some cases, we can put them on the mission to do the whole thing themselves. You provide them the mortgagee clause, provide them the loan number, and all that kind of stuff. But there's a good chance you're going to be going back and forth a few times until you get it right, um, because they may not always get it correct. We also need an invoice of the amount due. So we will need an invoice of the amount due, the declarations page, and an RCE. RCE stands for replacement cost estimate. The RCE is to confirm adequate coverage. Now, for those of you who will be originating Florida loans, keep in mind that in Florida it's very important to have a good insurance partner because um, in Florida, it's not a requirement for the insurance agent to provide the RCE. There was a court ruling on that states that they don't have to provide it. It's their prerogative. So what ends up happening is most of the insurance agents won't provide it, and then you have to work around trying to obtain it by like having them state the amount that they used, having them state that it's replacement cost coverage, showing policy verbiage that it's replacement cost coverage. So a lot of different ways to try to clear not getting an RCE. We have good insurance partners for Florida. So um, usually when I have a Florida deal, if they use one of our preferred partners, we don't have a problem obtaining the RCE. But do understand you don't want your closing held up by that. So understand if it's a Florida loan, this may present an issue, so you want to be prepared with quotes from your preferred partner as well as whatever quote the borrower obtains. Discuss the scenario, and if you can't get what you need from one option, then hopefully you will get what you need from the other option. And the invoice obviously has to say the amount due. Now, for refis, it's a little tricky because you need the same thing, and then most people question, but why would I ask for an invoice? Well, you're going to ask for an invoice, and the invoice is going to say paid, or it's going to say what's to be collected at closing. For refis, it's also a little tricky because you got to be aware of one thing. They have a current existing policy, but in most cases, if that policy is going to expire in the next 90 days, uh, you're going to be asked for a renewal as well. So you'll be verifying the current policy, and you'll also have to obtain evidence of the renewal policy for the refi. The current policy is going to have to show on the invoice that it was paid and the amount that was paid, plus your RCE, plus your deck page with our mortgagee clause and loan number. And then the renewal is the same deck page, loan with loan number, mortgagee clause, the invoice, and the amount to be collected. And we the RCE should suffice from the first policy. You don't need two RCEs, but just be aware, that it's a little bit tricky for the refis when the policy is about to renew. So don't get caught by surprise. So evidence, let's get some more conditions. Evidence that the prior year's income tax liability has been paid, or provide proof of payment arrangement and the last three payments made. This is another real tricky condition that if you're using tax returns for whatever reason, and the reason you would be using tax returns usually is going to be either a self employed borrower, or they have properties listed on the application from which they are deriving income, or some other type of income like dividend income, capital gains income, interest income, or something else similar, where it would be something other than W two only, right? Then you're gonna need your tax returns. And if it's the if the tax return shows a liability, then the underwriter is going to condition you to prove that that liability was paid. You will not be able to close the loan if there is a current tax liability. Like you're doing the loan now for 20 and you're looking at their 2022 tax returns and it shows $8,000 is owed, and they just filed it last month and they're on a payment plan. Well, guess what? They're going to have to pay it all in one shot if you want to close on that loan, because typically for any payment arrangement of any type, right, you have to show at least three payments made. So maybe you can extend the deal till your three payments are made, but you cannot make those three payments in one shot to satisfy the three payments to be made. It has to be monthly payments. So again, you can obtain, like I mentioned a little bit ago, the record of account tax transcript. That if they tell you, oh, I made the payment, well, one way is to provide that, and it's going to show a zero balance. Now, if the record of account transcript has not yet been updated, but the customer made the payment, well, then it's the same as the EMD deposit, where you're going to show the tax payment receipt from IRS.gov. They do give you a payment receipt, but that's just nominal in importance, because what you really then have to provide is the debit of the payment payable to to the U.S. Treasury, as well as a copy of the item where the pay that was used to make the payment, right? Or if they're on a payment arrangement, a copy of the agreement and the last three payments. One thing to note, that if they are on a payment plan, you have to include that payment in the DTI, because that is an obligation. So that's a double-edged sword, and some of those payment amounts could be pretty high. And if you're really tight on the DTI, just be aware. So obviously, one definite question you'd want to ask your borrowers is, do you have any tax liability that's unpaid? Another common condition is when we have free and clear properties, to confirm, if it's other than the subject, to confirm that they are actually free and clear, right? Just, so a couple of different ways you can do this. One, the easiest route would be to get a copy of the insurance declarations page for that particular property and be able to show that there is not an additional interest. In other words, no mortgagee clause on the declarations page. Hopefully, the borrower has insurance on that free and clear property. Sometimes they don't, in which case, then you would need an owner's and encumbrance report, also known as an O&E report. This is a report that shows any liens on the property, and it can be requested from the title company or from Data Tree. You all should have or have access to obtain a Data Tree account. The difference is going to be that if you order it from the title company, it gets billed at closing to the borrower. So you would obviously have to do that route up front in the process. If you wait till almost the end and you're hit with a condition, you're probably going to have to order it from Data Tree, which is going to allow you to get the report a little bit quicker, but it is at your expense, and then you would have to get reimbursed at closing. So if you're proactive, you could probably request it from the title company. If it caught you by surprise or you didn't think about it, well, then you're going to have to go the Data Tree route. Uh, Keep in mind that these conditions for these properties can occur in one of two ways. A, you listed them on the application, right? Or B, fraud report was run and came up with potential undisclosed properties. In which case, then we would have to verify, are they really his properties? And if they are, then add them to the application, add any liabilities if as applicable. Sometimes they have liabilities, they're just not on their credit report. They're held by an, in a different name, by an LLC, whatever it may be. Keep in mind, in some cases, with some of our loan options, if the property is a commercial type property, uh, it may not have to be included in the 1003. It can be excluded, but that is does depend on the loan option. Not all of our loan programs treat this the same. But be aware, free and clear properties do have to be confirmed free and clear prior to closing. Now, here's another interesting one. Confirm year to date income for a self employed borrower. So, the proactive approach on this would be, because what they're going to ask you for is to request a year to date unaudited profit and loss report. And it will have to be prepared. It can't be, usually cannot be borrower prepared, but you would have to check the guidelines for whatever program you're submitting it to. Usually it has to be prepared by their tax preparer or accountant or CPA, and you'll need to be able to verify their license or their PTIN would have to be verified if they are a tax preparer and not a CPA or an accountant. That's very important to note, because if the year-to-date P&L shows declining income, they're going to kill. They're going to probably ask you for additional conditions, and it could kill your deal if it's too much of a decline. So, take a good look at those P&Ls and question um, their accuracy before turning them in. Uh, Verify payment of the mortgages on the credit. Now, this is another interesting one that if you're proactive in your process, this should not catch you by surprise. Any mortgages on the borrower's credit report have to be verified as current through the month of closing. So if you're taking this loan application on October 12th or 10th, for example, and the borrower hasn't yet made, there's a good probability they haven't made their October 1st payment yet. But I can also tell you that it probably, even if they had made it, it will not show up on the credit report. The credit report will probably only have the September payment. Closing is on on November 21st, right? The late grace period is usually the 16th of the month. So any loan closing after the 16th of November, if on this particular loan, then you'd have to verify the October payment being made, and you also would have to verify the November payment being made. Couple different ways you can verify those payments being made. The easiest one would be to request a mortgage statement for each month in question that would show the payment. So, in essence, for this to work, for example, you'd have to have the November statement showing the October payment being made, and the December statement would already have to have been released so you could show the November payment being made. So, mortgage statements is one way to do it, or you can order a credit supplement which will update the payment history. You could order a credit supplement, and in your credit supplement, request specifically to update the payment history, right? You can also order the credit supplement to add a trade line for a loan that may not have been on their credit report, but you have the information. You can add the trade line to their credit report and verify the payment on that added trade line. And if it's a private mortgage, you may also need to order a verification of mortgage. So in some cases, you got to look at what their guidelines state. I just had one that was cleared with a verification of mortgage and the last three payments made on the loan. So, and that verified the loan, which was a loan not appearing on their credit report. Now, here's a tricky one: confirm excluded or omitted account is not the responsibility of the borrower. Now, there could be a number of things going on here, right? We could have a borrower that co-signed for somebody, co-signed for their brother, sister, mother, father, whoever. They co-signed. Somebody else is also on the account, and they are the ones making the payment. Remember, they also have to be on the account. It can't just be like this is in his name only, and they're paying it, and they're not even have any interest in the account. So if that's the case, then you would obtain proof of the last 12 payments made by the joint account holder. Another scenario could be that similar to this, where it's a business account, that is paying for, like you're self-employed, your business is paying for the car. That is so by providing the last 12 months proof that the business is paying for the car or the business is paying that credit card, then you can omit that payment from their DTI. Now, one thing that you have to be aware of is leased vehicle payments. They're a little tricky uh, because normally when there is a lease, um, it is assumed that at the end of the lease, the borrower is going to get another lease. So here you may be into a tricky situation of proving, that they're paying for the lease. They're actually the ones driving the car. You're not going to drive the car ever, and you're not going to re co-sign for them on the next lease, right? That could be a tricky one because leases are one of the accounts that cannot be omitted if there's 10 months or less payment either, which is another way to omit installment accounts is if the account has 10 payments or less, but that workaround does not work for a vehicle lease. And these last couple of conditions here, for our bank statement loans, P&L loans, 1099 loans, we sometimes get asked for acceptable third party proof of self employment. Now, the easiest route would be a letter from the CPA or accountant or tax preparer, just verifying how long they've been self employed, since when, their percentage of ownership in the business, and the name of the business. That's the easiest route. We do get sometimes borrowers that self prepare their tax returns, don't have a tax preparer. So the entity articles showing the formation date of the business and evidence that the business is still active is another way to show that, third party proof of self employment, because you can go to a portal and obtain this information. And current and past business licenses covering the time period in question is another way also of being able to prove that your borrower is self employed. Now, I mean, if you have a handyman who is a sole proprietor, doesn't have an LLC, self prepares his tax returns, and doesn't or cannot get a third party verification letter of any type, then you're going to have a tough time with that loan. So make sure you understand what all the requirements are before going too deep to make sure that you're not going to incur those. And last but not least, real easy one, verify the borrower is a U.S. citizen. We do get these requests sometimes for borrowers, for example, who their social security number may have been issued in recently, and that for the in these cases you may get conditions to verify their citizenship. So usually the easiest is to provide a copy of their passport, obviously an unexpired passport. Now there is a naturalization certificate, but you have to be careful with those because those really aren't supposed to be duplicated and copied or anything like that. So worst case scenario, your borrower doesn't have a passport, you may be relegated to providing that document to prove that they're a U.S. citizen, but leave that as an item of last resort. And that's my last condition there.
All right. Good stuff. I don't see any questions here in the chat. So I think we can go ahead and wrap it up. Remember that we do this at 7 p.m. Eastern Time every Tuesday and Wednesday. So we'll be back tomorrow with a new topic. So we appreciate everybody tuning in. Thank you, Jose. Great presentation. We'll see everybody tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Good night, everybody.